If you're wanting to buy a subject to deal in this market, I'm talking about keeping a 2, 3, or 4% interest loan that the seller has, keeping it in place, buying the deal and making it make sense. Again, with those numbers, it is imperative that you learn how to do those deals safely. Just watching a YouTube video a few times won't help. And guys, I'm telling you, there's even a lot of folks out there teaching about subject to that they don't know how to do them safely. I've been an experienced crave investor for years now, and it is painfully obvious that there's a lot of folks who are doing these deals wrong. We're seeing it across the nation. I'm definitely seeing it in my backyard. And so I am actually, because of everything that I'm seeing, the defaults, the subject to defaults where investors bought deals they should have never bought in the first place, all of these things, I'm calling an emergency masterclass on the topic of how to do a subject to deal safely. It's going to be August 17th, 2024 in New Orleans, and it's going to be a more intimate setting, kind of like a masterclass mastermind, where it's going to be in a house, not a big hotel room. And guys, it's important that you learn how to do these deals safely. My goal is to get you in there for an entire day, teach you as much as I possibly can, and give you a manual to walk away with. If you're interested in more information on how to do these deals safely, go ahead, go to CourtneyFricke.com for more information, or DM me the word subject to masterclass. Y'all stay safe out there. Hey, welcome to the Strategic Success Podcast. I'm your host, Courtney Fricke. Thanks for tuning in. Hey guys, welcome to the show. I'm excited today to be with one of my mentors, John Schaub, today. And John, thank you for inviting me to your home. So
my pleasure. We have parties here all the time, so it's
well,
a small party today.
Well, sure, it's a small party, but hey, still a fun party. So, but yeah, again, thanks. I appreciate it. I'm looking forward to the conversation we have today. So let's start off with, I don't know if I fully know this. What got you into real estate?
As a kid, I had a lot of odd jobs, as most people do, delivering papers, working construction and things like that. And one day I was working construction, and the guy who was selling real estate on the site where I was says, "Will you watch the office for a couple hours while I go to lunch?" So I said, "Sure." It was inside and air conditioned, and I was working construction, so that was a good job for me. And while I was there, somebody came along and they wanted to buy one of the properties, and so I took $100 from them. I wrote down their name and address and which one they wanted to buy, and he closed that deal and he gave me the $100. Well, I was making $60 a week back then, so I figured I need to switch careers, get out of digging ditches and cutting trees down, and get into real estate. And I knew other people that had been in real estate. My dad grew up in Florida, and I grew up in Florida, born and raised here. So I knew that real estate was a good thing in Florida, and decided that I'd take a shot at it, and took courses in college, got my license in college, managed a little apartment building while I was in college, 6 units I think, and I sold it. So I got another commission check there, but it was $5,000 this time. This is back when that would buy a couple new cars, so it was a lot of money. And I learned how to fly, bought an airplane, so I got into business full time right after that, and I've been in it ever since.
So you started off in the capacity as a licensed individual doing management, sales, but then eventually transitioned into investing, or did you start investing very early on?
Well, I started off, I got my license while I was in college, and when I got out of college, I took a course that was taught, a private course, weekend course. And while I was there, I got to know the instructors, and they hired me when I got out of college to start teaching that course.
Oh, wow.
So that was when I first started teaching back in the early 70s.
What was it on?
It was the course you took to get your broker's license.
Okay.
So, and I'd taken courses in college, so I understood real estate fairly well.
Sure.
Had a very little practical experience, but it was mostly about, the law.
Sure.
So it was good to teach that, because then I learned a lot about it by teaching it.
Sure.
And then I started, I was selling land for a year and sold a lot of land, made some money doing that. And then I opened a real estate office and had 13 salesmen for about maybe 3-4 months. Decided that was not what I wanted to do. And so I got rid of all my salesmen, and I bought my first house in 1973, which is about 2 years later. And
that's the house you still have.
Still have it.
Yeah.
And that started me down the path, and I'd already bought a duplex that I lived in. But I like buying things. That was a lot more fun than trying to sell them. So it's easier too, really.
Well, and so that's fair. So it reminds me of how, when I got into flipping, and I did flipping for a long time, I did it because I thought that's what you had to do.
Yeah.
And then I realized how much I hated it, but I kept forcing myself to do
Yeah.
things I
There was
hated.
money there. Yeah.
Right. And so again, got your license. You're like, oh, well, the natural progression is to have agents, your brokerage office, and agents underneath you, but not every hat is worth wearing, you know? So as far as, so you got in, so you bought that first house. Tell me about that first house that you bought.
It was owned. I lived maybe 2 blocks away. I was walking through neighborhoods, and I noticed this house was for sale. It had a little for sale by owner sign in the front yard. So I called the guy, and he lived around the corner. So I walked over and saw him. And his name was Joe. I'm not going to say his last name on the tapes, but he was he was a car salesman. He'd owned a car dealership.
So maybe a name a lot of people knew because.
No, he was from Boston, so they
Oh, okay,
probably
okay,
didn't
okay.
know him, and he's probably dead. I'm sure he's dead now because he was older than I was, but no reason
Sure.
to make his family famous.
Sure.
But anyway, uh, he was willing to sell it to me with owner financing, so we negotiated back and forth, and I didn't make a good deal on it. I paid pretty much a retail price, and I paid 20% down, which I had to borrow from somebody, and I paid 7% interest on a 20-year amortizing loan.
Right.
And
So
so it was-
retail price, and at that time, what was that, 73?
Yeah.
Would 7% be about average?
Yeah,
or?
well, it was like
Yeah.
today, really.
So
Rates are
retail
about today.
price, average terms,
Nothing
like
fancy
bank
about
terms.
it. The only thing that was smart about it was the owner financing part, where I didn't have to go to a bank because I probably couldn't qualify for a loan at the bank. You know, a salesman has a hard time qualifying for a loan because you don't have steady income. And I was young, you know, it was in my early 20s. And I tell people that's one of the best investments I ever made because I still have it. You know, and the key is to buy something that you're willing to hold on to for a while. And that's what I learned. Got lucky on that one, but I think that's the advice I give people: buy something that you're willing to hold on to for a while, which means that you're willing to manage it. You know, so it's not hard to manage.
Yeah, so I'm out of New Orleans, and I was somewhere, and so there was a hedge fund manager that I bumped into, and when I said I'm in real estate, he just kind of, you know, huffed and puffed, and he said, "You real estate folks never know when to get off the ride." And he was talking. He had said that in one way, but he had got me really thinking. Where a lot of investors actually prematurely get off the ride. They don't stay long enough to get actual benefits, right? So being that, you know, so I've been doing this for 10 years, I had a long stint where I was flipping and wholesaling and I wasn't keeping, and it was turn and burn. There's so many that if I would have kept, where would I be today? Because of that time. Now what I have kept, I'm starting to see the benefits of time, but I know I still have, you know, more time to go.
Well, you have a long time to go.
Yeah, more time to go to see more benefits. But like most people, they don't get to taste, you know, what appreciation, amortization, and various
And
things.
cash flow. I mean,
Even cash flow, yes.
Rents go up, you know, and you know, that house when I first bought it rented for $250 a month, and now it rents for $3,000 a month, and that's quite an increase. So if all you ever did was benefit from the rents, no appreciation, it's still a good deal because you know now you're making close to $3,000 a month on one house. That's a great deal. You know, it doesn't take as many. So I agree with everything you said.
Yeah, well, and I think that's okay. So I have this theory, and I'd be curious your thoughts on it. I think a lot of investors are being taught to be business people in real estate. You know, it's, you know, volume and, you know, for example, cash flow. You need to have a lot of houses because each one kicks off $100 a month in cash flow. And if you need 10 grand a month, well, good luck. You got to go buy.
Well, you only need three if they make $3,000 a month. You know,
Exactly.
It takes a while to get where you have a lot of cash flow from real estate, unless you get creative. And I'll talk about that when Pete and I teach. We always talk about things like that. But I've always found, and especially in the early years, that rather than trying to buy things that had a lot of cash flow, and I did. I bought a motel, I bought some commercial stuff, I had a restaurant, I had a wine and cheese shop, and these things had cash flow on a good day. But in a bad day, you know, in the summertime for my motel, they might sit and only rent one room, you know, it didn't have any cash flow. So businesses have more cash flow up front. They require more of your time. And most of the time it's cyclical. I mean, you know, it comes and goes. It's not steady cash flow. Rents are different. Rents are a lot steadier. You know, even during our big downturn where our property values dropped in half here in this town, my rents didn't drop in half. My rent stayed almost solid. And that's remarkable when you think about it, because people who are renters, especially during a downturn, don't want to move because that means it's hard to get a job. You know, they might be able to find a cheaper place, but they don't want to move. So it's steady income, and it's really what I live off of. I haven't sold most of my houses; I still have them. What I live off of is my rents, and those rents have gone up every year for a long, long time, and they keep going up. And it's partially because the dollar keeps going down. We've had this bout of inflation, which is nothing new. We've had inflation for a long time.
Yeah.
But as the dollar keeps getting less and less valuable, the rents go up. But you have the money with the extra rents, to buy groceries for $4 instead of $1 like they used to be.
Exactly. It's less buying power. So I generally like to read a lot, and we'll get to talking about your book here in a bit. But this year, one of the things I've done is saying, okay, I'll normally read 40 to 60 books a year. Just what can I get my hands on? But I've stopped all that this year, and I'm reading through Jack's newsletters for the first time, all of them. I have just about all of them, and mostly because I want to, being in the business for 10 years, I haven't gone through a downturn really. Like this is my first changing market,
You're
challenging
about to,
market.
maybe.
Maybe, right? I'm definitely seeing things. So, but part of me is saying like, okay, I feel my skills are half baked. I have bought a lot of things with creative finance. I've helped a lot of people in a lot of situations. So I have a lot of tools, but those tools haven't been tested. So it's kind of like, sailing in calm weather versus, not calm
Windy
weather.
weather, yeah.
And so, but at the same time, so one of the things I'm doing is reading through his newsletters is just not just seeing what the cycles did, studying the cycles, but also studying, what are people like Jack, and he mentions you many, many times in those newsletters. I know you and Jack Miller were very close. And so.
And we taught together for 8 years. So
Yes.
And then we actually taught together for 40 years, but every day for 8 years. Long time, yeah.
You guys, look, again, going through those newsletters, I saw that, each class you guys were doing, we're talking in there. But there's so many things, like right now I'm in the 80s, he's talking through, and I'm like, I could literally see that on a headline today and think it's the same thing.
Sure.
Obviously, there's some variables that are a little bit different. And so ultimately, going back to people have to give things time. Again, there's a level here. When I got started, I jokingly say that Phoenix has a lot of the new school real estate guys, the guys with the Lamborghinis and whatnot, who are maybe flipping or, wholesaling hundreds of houses a year or whatever. And then Tampa has the old school guys, but I was following all, like, let's just say the Phoenix guys, because I was doing a lot of flipping and wholesaling in the beginning.
Yeah.
And then I met Leon Johnson.
Yeah.
And something in me stood up, and I was like, that's what I want, right? And I resonated with that. And it was mostly because I was like burnt out from flipping and wholesaling and doing it in volume. And I was like, I did not get into this for that. I got into this for freedom and peace, to be able to, obviously hold these properties. And so, so I started doing that. And so you guys have shaped so much of my beliefs around investing. And your book is easily one of the number one resources I share with people, because people all the time say, hey, Courtney, I want to get into investing. What should I, is there a book I should read? Well, everyone tells them to go read Rich Dad, Poor Dad. And I often tell them, I said, it's not that it's not a bad book. It's just not a book about real estate investing. It's a mindset book about financial literacy and stuff like that. Your book brings so much practical advice. And so let's talk about, Building Wealth One House at a Time. Is this the third edition?
Third edition, yeah. I've rewritten it twice because the world changed twice. When I first wrote the first edition, it was right before the last big downturn.
94, I looked it up, yeah.
And then, so years later, I wrote a second edition, and they were selling so well, and they wanted me to write a third edition. So this is the last edition, probably.
Okay.
But it's, it's a great read. I agree. I think this is, Leon pushes this book a lot too. He's one of my favorite students.
Yeah. So, so Leon obviously introduced me to this whole world. I think the day I physically met him, he was like, 2 weeks from now, I'm going to a conference. You should go. And I just blindly booked a ticket and a flight.
There you go.
And I ended up seeing Pete and Bill Cook doing Whatbox. And so that opened me up to y'all's whole world. Had no idea what I was getting myself into, but I read that book, and I appreciated the principles in it. So what would you say is a synopsis of that book? Like when someone says, hey, well, what's your book about?
Well, it's a nuts and bolts book about how to invest and what to invest in, and how to do it safely, and how to acquire properties that don't require a lot of your time. People get out of the real estate business because they buy things that just attract tenants to drive them crazy, and they just can't stand it. And people will kid you about toilets and all that stuff. I've never fixed a toilet in my life. I delegate. I rent to people who will take care of their own houses, and I give incentives to take care of their own houses. And that doesn't mean they don't call me every once in a while. But an average tenant will call me once every 2 years. That's not a lot of calls.
Yeah.
My average tenant stays 10 years, so there's not a lot of turnover. And I've got tenants who've been with me 34, 35 years right now on that first house, 34, 35 years. Well, when you have an investment like that, it becomes more of a passive investment. It doesn't mean you just forget about it because you collect rent each month. But these people pay their rent on time because they like that house and they want to stay in that house, and they like me because I'm a good, honest manager who doesn't jerk them around. I do what I tell them I'm going to do. And so you can own half a dozen or a dozen houses and still have a job and a normal life, and it's not a full-time thing. And I encourage people, most people should go at that level. Most people shouldn't go out and try to buy 50 or 100 houses. That's crazy. Most people should buy 2 or 3 or 4 or 5 or a dozen, depending on where you live.
Yeah.
And in my book, I talk about buying 1 house a year, which is a lot really for most people.
Yeah.
But that's soon in their kind of moderately priced houses. If you live in a very expensive town, you can buy 1 house every 2 years or 1 house every 3 years and make it work.
Yeah.
It depends on your pace. But you need to learn how to buy houses that are the right houses with financing that allow you to have cash flow so you're not strapped, and to manage them well. And if you just learn those 3 things, it's not that complicated. It doesn't need to be that complicated.
Well, and as I mentioned, I think we see a lot of people who overcomplicate it. Like, for example, that instant gratification. I need 10,000 in cash flow right now, right? They don't want to give it that time factor.
They don't need 10,000 right now. They want 10,000 right now
Most of the time, correct.
If you need 10,000, like you have to go to the hospital, go to the hospital. You can owe them. They'll finance it for you.
Well, and there's various things like that. And I think there's a level there that, and I don't know if that's just thanks to social media and stuff like that, or if that's, the younger generation and maybe some first world problems of instant gratification or whatever. But there's a lot of folks I see who, so I'm in town this weekend for you and Pete's class so it's strategies for offense and defense on buying properties in any market, right? Towards financial principle. And I know that I have always appreciated from y'all the way you speak about defense, because so much of the message out there is go buy, or, refinance to the hilt, or, stuff like that. What are your thoughts around when you say buy properties safely? What does that mean?
Well, it's the financing that makes it safe, I think. Well, some properties would be risky too. I mean, there was an article in the Wall Street Journal today about a building, big tall building, 40-some story building in St. Louis that was sold for $250 million, sold for $2 million.
Yeah.
That's not safe. If you the reason I stay with houses, and I've owned a lot of other things, is I think houses are safer. They attract a safer tenant. You don't have as many slip and falls like you do in the commercial business. You don't have the big vacancies that you have in the office building or commercial business or the apartment building business. I own apartments, and sometimes you have half of them are vacant. You don't have any cash flow then. So the houses, I think, are safer from a cash flow perspective. They're easier to get good financing on. The banks like houses more than they like apartment buildings or duplexes, or certainly commercial or office buildings. Don't like them at all right now.
Yeah.
So if you're going to borrow money against something, you want an asset that has dependable net income, which means it's a pretty well-built house, not going to do a lot of maintenance. Not a hole that you have to
Sure,
put
not a
money into.
1902.
Yeah, not something you have to fix all the time.
Yeah.
And then you want tenants that are dependable. So if again, a smaller number, and that's kind of what I preach, is a smaller number, not a great big number.
Yeah.
Is easier to manage, and you can take your time selecting tenants, so you get good tenants who will pay on time or make it safer because you have the income, which is safer.
So I like that. So when I first got really introduced to you, Pete, Jack Miller, so I had to start detoxing some of my views around real estate. And one of them was, at that point, because I was doing volume, I'm thinking I need to own hundreds of houses. And when y'all were talking about really the average person needs 5, 10, not a ton of houses. But one thing you emphasize is that it's nicer houses and nicer neighborhoods. And so, because a lot of people, they chase the cheap deal in front of them, right? Like, oh, the house is $10,000 in Ohio, let me go get it, But it might be, an area that it's only worth 40,000 fixed up. So where did that philosophy around the nice houses and nice neighbors, like where did that come from? Like what's the thoughts and the story behind that?
Well, Jack and I, Jack Miller, who we've referred to a couple of times, lived in Tampa, Florida, which is just up the road from here. He was buying smaller houses. He was buying 2-bedroom, 1-bath VA houses, FHA houses. And first house I bought was a 3-bedroom, 2-bath house, not fancy, but a little larger house. And I just concluded that the bigger house in a little bit better neighborhood would attract a better tenant. And so the real question is not how many houses do you want to own, it's how many tenants do you want to have. And my answer was one, if I can figure it out. But the problem with one tenant is they move out, now you're 100% empty, so you don't want to buy one $5 million house with one tenant. That doesn't make any sense. But so we bought one, and I don't want people to misread this. When I say nicer houses, I don't mean fancy houses. I mean a fairly basic house, but big enough that a family of 3 or 4 or 5 people can live there and puts their stuff in there. And I've always tried to get houses with double-car garages, because in Florida we don't have basements. And if you give a tenant a double-car garage, they will fill it up pretty quick. And once they fill it up, they're less likely to move. So I've always kidded about, I want somebody that has some stuff. I don't want somebody coming out of a 1-bedroom apartment. I want 3-bedroom. I want somebody that needs a 3-bedroom house because they have kids and probably pets, which is okay with me. The house itself is not typically going up in value. It's the lot that's going up in value.
Yeah.
So I want to buy the best house I can that'll attract these tenants, but I don't want a fancy house. I don't want a fragile house. Landscape is not my big deal. It doesn't have to have perfect landscape. It just has to be a very livable house. And the important part is the neighborhood where people want to live, which is close to work, close to schools, close to churches. And if you buy in the right neighborhoods, then you're home free. Yeah. And you don't need many. Again, you don't need dozens and dozens. You just need a handful in a good neighborhood, and a couple different neighborhoods probably, just to make sure that sometimes you guess right, sometimes you guess wrong. They all tend to go up over time, but some neighborhoods do better than others. So if you want better than average appreciation and better than average tenants, you have to buy in a better than average neighborhood.
I think that viewpoint is something that really started shape with me, because in the beginning I bought the deal in front of me. Any deal in front of me where I'm like, oh, I could pencil it out, I'm like, oh, I'll buy it.
Yeah, I did that for a while.
Yeah. Well, and so then I had all this collection of, it was like a pawn shop.
Yeah, that's right. Yeah,
it was a pawn shop, a little bit of everything. And so the commercial, I had the mobile home parks, various things, land, trailers, houses, and all different types of asset classes. Yeah. So, but then I realized there was no congruity to it. There was a level that, like, my tenants were all over the place. Management looked different for each one.
It was. It's harder. I mean, when I had staff years ago, when I had a whole bunch of property, it was confusing to the staff because we had motels, apartment buildings, duplexes, restaurants, wine and cheese store. I mean, all of them different. I mean, there's no similarity.
One AC guy could not service all of that, right? Like for the most part, right?
Well, and you treat these tenants differently, and that's the hard part. They're different people in different places, so you have to be a lot nicer to some of them than you do others. And not that you should be nice to everybody, but people you want to stay 20 years, you take care of better than somebody's just there one night.
Yeah. No, look, exactly. So I remember, for years, so I've been learning from you guys for years. And I remember one time I went up to you in Vegas at the Masters in Real Estate Conference, and I said, John, you guys are talking about, having these, 10, 20 houses, nice neighbors. Like, John, I have a lot more than that. Are you saying I should start selling? And I remember you said, well, Courtney, how old are you? And I told you I think at that point I was in my early 30s. You were like, oh, at your age, I own, all these different ones, and you were figuring out. So talk to me about, for people who are starters, estate builders, and enders, what are some advice you give to folks in those different seasons? So I took it through, I'll say this, I took your advice through that lens that as an estate builder, I was trying to sort things out, but I know that I'm heading towards what I call my legacy portfolio, which is those nicer houses. So right now I'm trading up into those and cleaning out the rigmarole of all the different types of properties I have right now. And so I'm in that transition period. So what are some of your thoughts for people who are, in those different phases?
Well, there was a wise man once wrote a line that said you should write your obituary first and then kind of live toward that obituary, what you're going to be remembered by or for. And I think real estate's a little bit like that. You should think about what you want to own 20 or 30 years from now, hoping you'll be here, and go toward that. Now that may not be buying that to start with. You may have to build a path to that property. So you may have to buy some smaller properties. I certainly did. I own some smaller houses. I own duplexes, apartments, some smaller units, harder to manage units, but I learned how to manage. So buying things when you're a starter, first of all, you want to make sure that you can afford it. People get in over the head. They put a couple of different mortgages on them. They have negative cash flow, and they just don't make it because they can't afford it. So you have to buy properties you can afford, and that may be a lower price property. It may be a duplex. It may be a 5-unit apartment building. But those are harder to manage. But while you're younger, you have more energy. You have maybe more time. Maybe you have fewer kids. So you can do things like that. You can work harder. But you should work your way toward in the middle when you're just an estate builder. You should have quality properties that aren't hard to manage, because now your focus should be making more deals, making really good deals. You should get better at buying properties as you go along. So I've always been against the idea of a cookie cutter approach where you just do the same thing over and over and over again, because that means you're not learning anything. You're just doing the same thing over and over again. And the real problem with that is sometimes you're doing the wrong thing.
Yeah.
And I've seen people get all sorts of trouble because they thought they knew what they were doing, and they do 20 deals and then they're all wrong.
Sure.
And they're in big trouble. So when you start, you're going to make some mistakes, but you want to make your mistakes small. When Jack and I taught, I came up with the title for our class, which was called Making It Big on Little Deals. And I said, if you make a little deal and it goes bad, and you probably will, you're not out of business. But if you make get involved in a big deal and it goes bad, you probably are out of business for at least a couple of years. It takes you out, and it's a mental cost too. If you go broke, that'd be a mental problem.
Sure. I mean, that's what we're seeing with a lot of these office guys, apartment guys. Airbnb bought all these Airbnbs. Like, we're seeing that. And some of these folks, by going really big, something you guys also taught me that, Courtney, it's like, these guys there's a lot of people who with you guys over the years who are no longer with you, not because they maybe passed away, but because they're no longer in the business. They basically bought too much and overdid it, or didn't have that safe financing or the good deals.
Yeah, they didn't make the good enough deals. So I tell people, every deal you make, before you make if you buy a house today, go out and get it rented first of all, and make sure, and then think about both of those things. Think about, when I bought it, could I have bought it cheaper? Could I have bought it with better financing? Was this the house to buy, or is there a better house I could have bought? And then when you rent, you have to ask yourself the same questions about that tenant. Could I have found a better tenant if I waited a little bit longer? Are these the right people? And if you did everything right, that's wonderful. Then you go out and look for your next deal, or you say, okay, the next deal has to be a little different. Here's why. It's got to be a little bit better neighborhood, a little quieter street, a little bit better house, and then the next tenant has to be somebody who will stay longer, has more income. So you just get a little bit better at it. You're thoughtful about it, not just helter-skelter out buying everything and falling in your lap, like you and I both did when we first started.
Sure, and many people do that. I mean, because they get so transaction hungry.
Oh, it's just fun. It's just fun buying stuff. And I could go out and buy 5 houses this afternoon, but they wouldn't be the right houses, and they wouldn't have great financing. It just wouldn't be smart to do.
Yeah.
But when I teach classes, and I haven't taught a class now in a number of years by myself, but we would go out in the class, and every time they found a house they could buy. Every time. And I taught that class 100 times. So you can go out in an hour and find a house that you can buy. Yeah. But it doesn't mean it's the house you should buy.
Yeah, I think that's critical. I love your idea of like a deal analysis and review, because part of my problem was I just got a lot of balls moving in a direction, and I wasn't necessarily analyzing what I was doing to the point where I was like, hey, can I make those little adjustments? It's kind of like when you're driving a car direction wise. Well, if you get off track a little bit and you don't analyze that enough, you end up, instead of going to New York, you start going to Atlanta. So, and I'm speaking from New Orleans, right? So, but the reality there is a level that helps make sure you're heading in the right direction. So starters, right, they're figuring things out, making little adjustments. Estate builders, they're improving, or what they have is, you said, improving the deals that they have. So
get better at it.
Yeah, getting better at it. So like, for example, as a state builder right now, I have some nicer houses and nice neighbors. I'm working on and getting more of those. But one of the things I'm doing is I'm also thinking towards eventually descaling and with leverage.
Yeah.
Because I, used leveraged a lot to get the deals that I have. But at the same time, I also am trying to arrive places, and I'm thinking about my debt when I do it. Not necessarily from an economical point, but it's like, how did I want to arrive? Do I want to arrive with all this debt and have that be something a part of it? And that's various. So like a lot of my subject to stuff right now, that is what I'm focused on. Maybe walking some mortgages to move to remove that subject to debt, or just various things like that. It's not just the nice houses I have, but also it's again looking at that financing with it, and is that something that I want to have?
Yeah, well, and it's interesting because the houses I've owned for a long time that started off with loans. I mean, like the first house I bought has been paid off for 30 years, so I've had 30 years of big cash flow. But even the houses I bought 5 or 10 years ago, the loans looked big at the time, and they were like $250,000 loans, and now those houses are worth 600. So the 250 doesn't look scary anymore. So I think it's good to be in debt, especially if we have a government that's going to continue to have inflationary policies, which I think we probably will have. Being free and clear is okay, but you're not getting ahead. You're just holding on to what you have at that point.
It's preservation,
So,
yeah.
yeah. So if you're still building, if you're still trying to go from 1 million to 5 million, you have to use debt. I mean, and that's okay, but that needs to be safe debt, and that's where Dave Ramsey is letting people down. He's encouraging people to save up the money to pay cash for a house. Well, you just never get that done. I mean, the house goes up faster than you can save, and you're saving after-tax dollars. So I like Dave Ramsey, most of what he talks about, but I don't think that's solid, So you need to be wise about the leverage you use, but there's safe leverage out there, and safe leverage is basically leverage, with payments lower than the income is going to produce, so you don't have to worry about it.
Sure, and fixed, and those things matter because I mean, for example, most likely that office building traded at that lower valuation because of either income issues or financing issues.
It's empty.
And both.
It's empty.
empty.
That's why I traded it. It's got a 40-story building that's empty. You can buy for $2 million and have a 40-story building.
Yes.
I won't mention anybody's names, but I've seen people go out and do that, and they buy things like that because it's so cheap compared to what it costs to build it, but it's worthless. They're going to tear that building down. I had a building here in town. They had a $37 million loan on it. They offered it to me for $5 million. I offered them $2 million. They sold it 5 years later for $4 million after paying taxes and insurance on an empty building, and they tore it down. And my offer of $2 million, but I knew I had to tear it down. And this was a 5-year-old building. This wasn't a 50-year-old building. It was a 5-year-old commercial building. And but it just was the wrong building in the wrong place. The land was valuable, but the building was not valuable. So that's the other thing that makes the residential business safer is when you buy a house, that's probably the highest and best use for that land is a house. It's not a commercial building. It needs to be something else. You don't have to be you don't have to be a smart to do that. And the guys who have these REITs and hedge funds think they're geniuses some days, but some of them will probably go out of business because they are leveraged and they're buying stuff like that big office building. And who knows how that's going to work out.
So I had a friend that did a ton with a lot of the hedge funds for a while, wholesaling off market deals to them. And so I got involved on some of their house packages, and actually some down here, maybe three or four house packages down here to see. So we had an in-house valuator that we had all these different hedge funds that if we input a deal, it would tell us what each one, if they would offer on it and what it would be. And some of them were up to like 115% of the value of the properties, what they would pay for certain properties, just houses, right? We even saw them paying for options, for pure options. And so that actually intrigued me. But it was very interesting to see some of those things. It's an interesting model. But what is?
Well, what the problem the hedge funds have is they have too much money. These people go out and raise the money first, and then they go look for the real estate. And if you're going to be a real estate investor, we talk a lot about investing with other people because I do a lot of that. You find the deal first, and then you raise the money. And it's just inside out because if you have the money in your hand, now you have to spend it. And that's why those hedge fund guys pay too much sometimes because they've got $1 billion sitting in a bank earning 3%. And they need to get it going somewhere.
Well, and they have investors with demands for returns.
A lot of pressure on them.
Yeah,
the best deals I ever make is when I have no money. Because then you can't give somebody any money. All you can do is solve their problem and buy something. So
it's kind of like when people say, "Hey, I just inherited, or I have $200 grand in the bank. I want to get into investing. What should I go buy?" And one of the first things I usually say is don't use your own money. But yeah, you should go buy the
Buy the
book.
book.
Yeah, you should no, educate yourself because
Absolutely. And don't take advice from somebody who's trying to sell you something,
exactly.
and that's what a lot of people do. They take advice from a salesman, and you know what you end
Sure.
up with, whatever they're selling, insurance,
Exactly.
stocks, whatever it is.
No, and I think that's critical. So, obviously you've been investing since the 70s and you've seen a lot of different things. So, you know, um, what has been one of your most profound deals on your investing career? Like something that has impacted you and your family. When you think about all the deals you've done over the years, what's one that stands out as, maybe pivotal, profound, impactful?
Well, I'm talking about both good and bad. The bad deals I got into were deals where I thought I was going to make some money in a hurry, and it didn't happen. Either the economy changed, we bought some things at the top of the market last time, and then the prices dropped way down. Well, if you sold them after the market dropped way down, you took a loss. And fortunately, I didn't buy a lot, but I did buy some. The stuff I held on to is now worth more than what I paid for it. But the stuff we sold, we had to sell for a loss. So what you learn is you just don't know what tomorrow's going to bring.
Yeah.
And you don't realize how fast it can change. It can change overnight.
Right.
Things can change so fast you can't get out, So a couple rules. First of all, it's a lot easier to buy than it is to sell. Always has been, always will be. When you go to sell something, you're at the mercy of the market. We've had a lot of new listings in this market just in the last 6 months. A lot of new listings, and that's affected the market because now people have choices. And if you look, and I was on the internet this morning, people send me stuff all the time, and I looked. I think there were 20 houses in this email, and 15 of them had reduced their prices.
Yeah.
Well, that's a sign, and probably it's a sign that they are overpriced to start with, because
Sure.
I don't think the market's dropping, like a knife at this point, but it's changing, and the market will continue to change.
Yeah.
I love change. When the market changes, that's when I perk up.
Sure.
I'm looking for a way I can help somebody, and some of the deals we made during the last downturn were helping people survive. We would buy their debt and refinance for them so they could afford the new payments, because the bank either wanted to be paid off or the payments were so high they couldn't make them. So there's a tremendous opportunity in down markets to help people and share profits with them. You don't take them out, you just don't wipe them out, but you find somebody who has lots of equity, typically, millions of dollars in equity sometimes, and you're able to participate in that, share it with them.
Well, actually, reminds me, I'm talking with you about a deal afterwards. But I mean, I literally am getting phone calls now with investors who are equity rich, cash poor, and they need liquidity today.
There you go.
And so there's a level here. There's a lot of things I've heard you guys talk about for years, but I haven't seen them. So that's part of the reasons why I get around you guys as much as I physically can, because I want to show up as an investor in a changing market with tools and a philosophy that can help me, because not every market do people benefit. Some people lose out, right? Like they get hurt.
Well, yeah, and you hear stories like, I could have sold a house for $500,000, I ended up selling it for 300. I always said, well, what did you pay for it?
Sure.
Somebody only paid 100, and they thought they could get a $500,000. They didn't lose 200,000. They just didn't make the money they thought they were going to make. And there's a lot of folks like that. People that have invested over the last 10 years typically have a profit right now, and a lot of them have a decent mortgage. But interestingly enough, a lot of the folks with the low mortgages are paying them off. They're refinancing and selling and buying more property. So those 2 and 3 and 4% loans are going to disappear, because people are, they once they get a whole bunch of equity, they just can't stand it.
Sure.
They bought a house for 300, now it's worth 800, and they have a $200,000 loan. Well, they say, 200,000, no big deal. We need a $600,000 loan, so they move on. But I'm excited about change, and because there's always opportunity to help people, and I think that's the message you have to hear. We're not out taking advantage of folks. We're finding people that need our help, just like you're talking about, an investor who has good property but can't afford it right now. And we found people like that. We found people that had land that couldn't afford it. We're able to do it. If you've heard me speak a number of times in the last couple of years, and I've been telling people for the last 2 years, do two things. Make sure you have good tenants. So if you have a bad tenant, get rid of them while employment is high.
We're doing spring cleaning right now.
Yeah, get rid of your bad tenants. And number two, if you have the ability to either raise some cash or find investors that have some money, find them now before you need them. And for the last couple of years, we've been stacking cash up, because I know this is going to happen at some point. I don't know when, but I know, I want to be bulletproof when it happens. I want to be in good shape. So, when COVID hit, you wake up in one morning and here we have COVID. Nobody saw that coming, but you say, well, what if all my tenants die? What if they all move out? Can I survive? And the answer is, well, if you had some money in the bank, you could. Of course, that didn't happen. People stayed and we raised our rents. It was kind of a weird thing. But you don't know which weird thing's going to happen next.
No, you can't predict it. Government interference or things like COVID or whatever else, like you can't predict what those things will happen. And so, one of those things, again, going back to the defense, obviously I've learned how to play a lot of offense with you guys, but I've also learned that defense. And so I've been restructuring a lot. And I think we have our last little bit of spring cleaning that we're doing.
Good.
And just saying, hey, we want to be able to make sure as the waves come, we can ride them.
Yeah, absolutely.
And help at the same time.
Yeah, we've had this wave of inflation, and it'll stop at some point probably, and we could even go into a recession. You never know what's going to happen. So you just want to be ready for both sides. And one way you can get ready if you're just getting started is having something free and clear. I mean your car, or some cash in the bank, or maybe some equity you can borrow against. And then an investor lined up it's easier if you're going to deal with an investor to deal with something you already own than it is to get them to put up money for a new property. So if you can go to an investor and say, look, I have a $200,000 house with a $100,000 loan against it, will you loan me $25,000? The answer is probably yes, because there's a lot of security there. But if you say, I need 25 to buy this new house, and we'll put 25 down, but now we're going to owe 80%, that's a much riskier deal. So you can take the risk out of the deal, and that's an important thing to learn if you're dealing with other people's money. You don't want to be taking a risk with their money.
Well, and I think that's critical because obviously I even hate saying the word private money because I think it's also misdefined, but just using money from everyday folks, whether it's their IRA, their 401k that's self-directed, or, retirement, cash in the bank, whatever that looks like to fund our deals, there's got to be a level of respect with it. And, respecting that, in changing markets, the risk is higher.
Well, and you may think those people see that they're taking a risk, but they don't really see that. They see that they're giving you money and they want the money back from you. It's a personal thing.
Yes.
And that's the way I look at it too. If I borrow money from somebody or bring an investor into a deal, if it's an investor and we're in a deal, we're just going to hold it until we make a profit. I mean, sometimes that takes 10 years, but if you hold it long enough, you're going to make a profit on that. But if somebody borrowed money I borrowed, I'm going to pay them back even if I have to sell something else at a loss to do it. We're never going to stiff somebody for money we borrow. But borrowing is, going back to risk, the riskiest thing most investors do is borrow money. I mean, people worry about asset protection and all that. It's really, can you pay the money back that you're financing? Because if you can do that, you might get sued, but the chances are like 1 out of 1,000 or something. But if you don't pay the loans back, the chances are 1 out of 1. They're going to come see you. And taxes are the other thing. You have to deal with. You have to be smart enough to understand the tax law. So you try to use that strategy the best you can.
Yeah. Now, taxes in not property tax, but Uncle Sam tax.
Uncle Sam tax. Property taxes are hard to negotiate. You can work on them a little bit. Uncle Sam taxes, you just have to understand the system, because the way you amass a lot of wealth is you avoid paying taxes on that growth, which is as simple as buying a house and holding on to it, because if it goes from 100,000 to 500,000, that's a $400,000 profit you haven't paid a dime in taxes on.
Yeah.
Okay? And that's so much better than trying to make $400,000 flipping houses. And that would be after taxes. You'd have to make $700,000 or $800,000 before taxes just to have that same amount of money, and that's a lot of flipping.
No,
That's just one house you could buy.
What did one of Jack's newsletters say yet? That the government hasn't figured out how to tax unrealized gains yet?
They're thinking about it.
Yeah, sure.
They're thinking about it.
They're thinking about it. So what led you to writing Building Wealth One House at a Time? Just to shift back to that.
Well, I have 3 children, and I want to, primarily have them have a rule book or a book they can follow with investing. It's just kind of common sense things that I've learned over the years that they could read, and they've all read it, and they've all helped me edit it, and they edit my newsletters. They do a lot of things for me. So they're involved, not at my level, but they all own real estate, and they all like real estate, and they understand how it works. So that was the primary reason. But then it's good for me to write. I like to write. I'm a writer. I've been writing newsletters. Jack and I wrote newsletters together back in the 70s.
Yeah.
So
I've read many of your newsletters,
I've been writing since the 70s. So I've written thousands of pages. and this is the three here, but I've written 3 other books too. So
I didn't know that.
yeah.
Well, you know what? I do have one of them.
Yeah, we
I
did
remember
one
I
on
showed it to you.
foreclosures, and we did one it's called Building Wealth in the Changing Market,
Yes.
buying foreclosures. Then I wrote one called Buying Right back in the 80s, long time ago.
So you said buying right?
Buying Right, but it's out of print. It's been out of print.
So you know what? I did know that. I do have your changing market one and the foreclosure. So building wealth, buying foreclosures, building wealth in a changing market. I have both of those. That's right. But then the other one I have is the pyramid. It's like a red book, something Pyramid House.
Yeah.
You and Jack.
Yeah,
I remember I brought it to you and you were like,
that thing just falling apart.
I may have gotten it off of eBay.
Yeah.
So, but then, okay, buying right. I'd love to, I'm going to have that on my radar. But so I enjoy that idea. It's like leaving your family, that common sense. I've always enjoyed that about you. It's a very common sense approach to real estate investing, because a lot of average folks, and this is something Leon taught me from early on, it's like, an average person can buy an average house, rent to an average family, and over time, charge an average rent over time, build a tremendous wealth, right? Like you guys have drilled that down, and I appreciate your common sense approach to it, because some people like to make it out, that, oh, I'll never be able to understand that, or that's too complicated. No, really, anyone can do it. And so I've appreciated that. What has writing that book, I know you started out to do it as like a guidebook for your kids and stuff, what does that impact look like on your career? Or how have you used that in your career?
Well, it's helped a lot of people. More than 100,000 people have read that book. So I think it has somehow helped them move along. If I was 40 years younger and wanted to go out and teach a seminar once a month or something, I'm sure the book would bring people into the seminar. I only teach once a year, so we're not pushing people very hard. And but it makes you think when you write anything. If you just write down your goals for the next 10 years and put them in detail, like not only houses, but which house and how much am I going to put down and what kind of loan am I going to have on them and what kind of rent will I charge and where will they be? And, if you just go through an exercise like that, it makes you think through what you're going to do. And it just makes me think through what I've done and what I'm going to do in the future. So it's good to exercise your brain. I exercise physically every day, but it's good to get the brain going too.
Well, and that's been critical. So I went from a very vague view of what I wanted out of real estate to, again, being around you guys, I got very clear.
Yep.
And I now have a very defined set of what type of house I want. I have like an avatar of what it looks like, what neighborhood it's in, the area, what could it rent for, even what year it was built, things like that. And so that has helped me. And actually numerous people in my life had said, Courtney, your clarity, is something I don't see often. And I'm like, well, because it isn't there. A lot of people don't have it. So
most people don't have it.
So when I talk about philosophy of real estate, it's really like your worldview, your view of it. What is a piece of your philosophy around real estate what do you wish you could leave with everyone? I know a lot of it's encompassed in the book, but what is one way that you view real estate that you wish you could impart to every investor?
Well, the book is really kind of my vision of where you should go. But it's first of all being fair with people. I mean, you don't have to. You don't have to take advantage of anybody. I've never bought a house from anybody that wasn't happy with the deal. I've had a couple tenants that probably aren't happy with me because they didn't pay the rent and they had to leave. But just a couple, just a handful over 50 years, not a whole bunch. So all my current tenants like me a lot. I guarantee it. You can ask any of them. I get letters, I get Christmas cards. They like me. So you can be a good landlord. Pay your debts. If you do borrow money from somebody and you get in trouble, figure out how you're going to pay them back. Yeah. Don't develop a reputation where you borrow money and you don't pay it back. So it's just that simple. I mean, it's not a complicated philosophy. And then buy the best property you can afford. When you start to buy things, try to buy the best thing you can afford. And again, I don't mean a fancy house, but I mean the best neighborhood you can afford. Buy a simple house in a good neighborhood. It'll attract better tenants. And you might have to stretch a little bit to do that. And I bought properties that didn't make a lot of money or didn't make any money the first couple of years. If you really bookkeep all the taxes and insurance and maintenance and payment, you might be losing $100 a month on some properties. But they were the right properties in the right area, and I knew they were going to be home runs long term. Yeah. So sometimes, especially if you buy with a lot of leverage, when you're starting, You know, if you buy houses, one of my students, Margaret Allen, wrote a book based on my class, and he called it Nothing Down. It's a good book, best-selling book.
Yeah.
But if you buy something with nothing down, you owe a whole bunch. And if you own a whole bunch, you're not likely to have any cash flow unless you got very creative in your deal.
Yeah.
So, you know, it's okay to buy something with a very low down payment, but you have to make sure you're going to survive. You know, make sure you can make the payments.
And I think that's critical. So, for example, buying deals subject to the existing mortgage is very popular right now.
A lot of people pushing that, and it's dangerous.
It very much is.
I wrote a newsletter. You probably read it.
Yes, I have.
Yeah.
So it is. And so, for example, what is some of your advice for that? So obviously you've been doing subject to transactions for years. It's not the only type of deal you've done.
No, I've done a few, but I haven't done as many as probably you have or other people, because I don't do it on purpose. I just do it when it happens. The last house we bought, we took subject to a loan to chase, and we have since paid it off, but that was a couple of years back. But when I buy a house subject to, I always have a plan to either get rid of that debt, by bringing an investor in and paying the debt off, or by, I know something else I'm going to sell and come in and pay the debt off, or exchanging it to start with it, pay the debt off. So,
Yeah.
Because you know, there are some loans you could take subject to that'll probably be on the books for years and nobody will call you. But there's other loans that they may call you on, and you don't want to ever hurt the people who originally borrowed that money.
Correct.
And that's who you're going to hurt if you don't make their payments.
Yeah, as well as eventually yourself with maybe ramifications from that,
Probably
right?
so. But you don't. Again, we're talking about making good deals on both sides. And if somebody's walking away from a house and you can take over their loan and you can make the payments for a while, and you have Plan B, you have a way to pay that debt off, or you're pretty sure that you can make the payments, the lender won't call you for a year or two. That's a chance you take. It's a reasonable risk to take.
Yeah.
But the people who do many of them are the ones that have a lot of exposure.
Exactly.
And I have a good friend, he's a good student who did about 30 of them. And then he called me just not long ago in February. He said, I just paid off the last one, and we're sleeping a lot better.
Well,
You know?
so that's very much where I'm at right now. So I don't know where my number is, but it's higher. I don't have them all still. I've sold sold various ones, but I've never refinanced one, and that is the phase I'm getting into right now. So thankfully, I have bought them. I've bought the majority of them very safely. So I've got equity, not necessarily from appreciation, but from just equity capture day one. But because I've got there's a level in which if you gave me, 25 houses that were all subject to, most situations around that, I would not sleep well at night. Now, if they were 50% of the equity and they were subject to, maybe it would be different.
Yeah. Well, it's not just the equity and the amount of profit you have, it's all the details. It's keeping
Correct.
up with the insurance, keeping up with the taxes, keeping up with the mortgage payments, the mortgage holder. They keep changing. They sell those notes all the time. So there's just more details to take care of.
Yes.
And if you're full-time in this business and you're good at it, you can handle that. But if you're new at this business, things can go wrong,
There's a lot of moving parts. It's very sophisticated.
Yeah,
And, at the recording of this, I had mentioned about how, when I came here, that unfortunately there was a tornado in my hometown yesterday.
Yeah.
And I'm looking at the damage that some of our properties received. I'm like, which one of them, are subject to that the claim is going to be just a little bit different than the other ones.
It will be. And they'll write a check back to the lender probably, or to the person who took the loan out.
Both.
You're not in the group.
We had a hurricane 2 years ago, and I had to do a whole bunch of insurance claims with my subject to properties then as well. And so there's a level that again, there's more nuances, there's more risk and various things. And so it goes back to that safe financing. And so I'm to a position now where, as I mentioned, not only am I finishing acquiring certain quality of properties, but I'm also restructuring that debt. And one of the first on the the first on the chopping block is the subject to debt into either private money or maybe walking a mortgage from some seller financing. And so I have appreciated, again, you guys' philosophies, because you have really helped me look at things maybe with a more level-footed approach. Because for example, there's a lot of folks who are buying properties, they're drunk on a 2, 3, 4% loan, but they're buying properties at 100% or 105% of the value with subject to debt. I'm seeing that very consistently right now.
Yeah, if that debt gets called and they have to refinance at hard money rates, they're going to lose those properties because
Yes.
they paid too much for them. It won't rent for enough to cover the hard money rates, or even just regular bank rates at 8%. If they started off at 3 and they're breaking even at 8, they're not breaking even.
Exactly.
They're way up.
And most people don't have the liquidity. That's also another thing is,
Most
yeah,
people are too thin. Yeah.
yeah, they're too thin. They're property, so very common, they'll be property rich, cash poor, right? They won't have the, so right now in Louisiana, similar to Florida, we're having that insurance crisis. We've been having it for years, the insurance crisis. So for example, I bought a great property in a great neighborhood subject to the debt in December. The monthly PITI was $1,700. It was a 3.125% loan.
Can't get any better than that.
Yeah, it was, I mean, it was great. And so now I bought it at 1,700 PITI, knowing it would adjust some with, it was owner occupied, so that would adjust some, but it would rent for 2,300. So I knew I had some spread there. Well, they did an escrow analysis because not only insurance is going up as with here, it's very high in Louisiana, but mortgages require that escrow buffer. And now with that escrow analysis, it's now $2,300 a month, and it rents for $2,300. And so I currently don't self-manage, which is something eventually I want to bring in-house. But so I've got a management fee with it. So in essence, it's losing right now. But I know, so a lot of people, they can't handle that. So I might be able to, I can handle that with some of the other things I have going on. But most people, they can't handle that negative equity, right? Are you guys seeing that a lot down here in Florida with the insurance?
Yep. Taxes and insurance, everything's going to go up. I mean, the government's going to keep making it more interesting for us. I won't say difficult, but interesting for us. And part of that's going to be property taxes increases. In Florida, we're fortunate. We had a lot of people move here over the last 4 or 5 years.
You guys have the economic engine.
So we have, I mean, the government has income, but that doesn't mean they're going to be smart with it. They will spend every nickel they take in, and they'll be short again, and they'll raise taxes to cover that. So you can count on that. That's one thing that's predictable. The government will continue to spend more money and become more involved in our business. And I encourage people to become politically active. I mean, if you don't show up at your county commission or city commission meetings and protest when they want to do something stupid, they're going to do something stupid. So you need to, that's one real advantage that we have today over when I started, is there were no real estate investment clubs when I started. There were none. So having these real estate investment clubs in every town, you can mobilize people and have 30 people show up in a meeting with T-shirts or hats or something and get something done.
So New Orleans has been going through the ringer. We had a landlord registry pass, but it wasn't passed to the degree they wanted it to, where every landlord had to basically register, and there was going to be an additional inspections for landlords, and this whole thing.
These are just fundraisers for the government.
Fundraisers, right? They already have.
Those are taxes.
Exactly. And that was last year. That was the first time I ever kind of politically got involved. And then they've also been very restrictive with Airbnb. I got involved a little bit with that. I don't only own one furnished property, and even then it's because we use it as well. But there's a level there that, I shied away from it for so long, but, Jeff Watson and I have had some conversations about this, hearing you, it's like a level that I feel a responsibility. You can't be a bystander. And I almost took that approach. And so give me your thoughts, investing now and thinking about investing in the future, whether it's you continuing to buy deals, your kids buying deals in the future. What are your thoughts around really just the changes we're seeing? Some people are discouraged, with what they're seeing now, with government interference and stuff, and then thinking forward.
Well, I've always said if you can't figure out a way to outsmart the government, go to work for them. It's a good job, nice and cushy, nice retirement pay over there, but you never have any money. You have to figure out how to work around it. And every time they change the law, and I've seen a lot of law changes in my career, we figured out a workaround. So you just have to think that way. But again, going back to my strategy of buying houses rather than something bigger and higher profile, they're the last things to be regulated. The small residential landlord that owns a half a dozen properties is more likely to be able to sneak under under,
The
under
apartment complexes.
line. Yeah, the people that, they're talking about regulating hedge funds. They'd love to do that because they own all these properties and they want to
Right.
pass laws that will affect them.
Yeah,
So
that's the
corporate
big bad
ownership,
guy right now.
yeah, corporate ownership is a big deal. So you never want to own your property in corporations anyway for tax reasons. But they're going to go after the big people. And if you're small enough, you'll probably be able to work around those laws. Or ended up with different entities owning properties. If the raw law says if you own 5 or more, then you only own 4 and have somebody else own 4. Might be your spouse, might be your kids. You just sort of work around here. You have to be smart enough to work around that. But in the future, I think the government will continue to try. But there's, we've seen waves of different kinds of regulation come and go in the government. We have less regulation in this state than we had maybe 10 years ago because we have a Republican governor, a Republican Congress for a long time, and that's helped a lot from a landlord's perspective. But if you're in a state where it's going the other way, you have to think about that. But even where there's rent controls, I mean, that's the most burdensome thing for most landlords, I think. The rent controls are silly. They're like, you can't be more than 10% a year. I said, I don't raise my rents 10% a year. We'll start.
Sure.
So,
But that's when you buy it right and when you have safe financing.
yeah, or if you have existing stuff, But if you bought something with safe financing, you have good cash flow to start with. If you can only raise your rent 3% a year, or 5% a year, or 10% a year, as long as you raise your rent, you're doing okay. Rents are going the right direction, and I think you'll always be able to raise your rents some.
Yeah, as long as you can survive with costs like insurance and taxes.
Well, and then you figure out, like, we self-insure a lot of things because the land value is worth there's as much value in the land as there is in the whole property. So if the house does blow away, and we've never had a house blow away, but if it did, I know you may have, then at least you have a lot. So if the lot's worth 100 and the house is only worth 20, you didn't lose a lot.
Yeah. It's really hard to lose
that
a
lot
lot.
anyway.
Yeah, that lot, right? I caught that pun there. But so, and that's something I've really appreciated from you guys. All right. So Louisiana, Florida, the Gulf states, we have that unique struggle with hurricanes and various things like that. Insurance crises that we're seeing right now. See, a lot of folks are just saying, I'm going to get out the game. You can't, things don't make sense anymore. They want to move.
Go buy in the stock market and see how it works for you.
Yeah, but the thing here is, and that's also one of the things I've learned a lot from you guys is like, getting away from institutions can allow you to be more creative with insurance. So, having a private individual who would be willing to let you self-insure because the land value, right? Now, but most people don't think about land having a, it's part in the valuation. They don't think, they're like, oh, it's worth 300. They don't think, well, but how much is the land worth? And so y'all, that was a great switch. And so when I think about buying the nicer houses, nicer neighborhoods, I go and look is what's land
the lot
selling?
worth? Ask yourself that question. Look for the ratio between the lot and the house, and you ideally want to buy as much lot as you can and as little house as you can, dollar-wise, not space-wise, but dollar-wise.
Yeah.
But the insurance people love it because if you go out and buy a house for $300,000, they want to sell you $300,000 for the insurance, even though the lot's worth $300,000.
Or 600 a replacement.
Yeah. So those are the ones I don't insure because then I know if something terrible happens, I haven't lost anything.
Yeah.
And take that risk.
And so these are the philosophies I've really appreciated. So going back to government changes and just the world changing, or everything from insurance crisis, whatever, right? That it is getting around other creative investors. You mentioned having those clubs and various things. Coming to weekends like this, every time I come here, I usually write down what's some of my agenda. Maybe it's things like coming and doing this podcast with you here at your house, or going and attending some of the local meetups. Like this morning, I was at the exchange meeting trying to move a few deals, do a few deals. But it's also things that I'm working on, right? Like, hey, I have this one deal, I'm trying to do X, Y, Z. And it's by getting in getting around other folks and talking through it, that always makes a world of a difference.
You'll get an idea. You will. Probably the hardest part of this business is most of us work pretty much by ourselves. We don't have a group that we meet with every day, but having these groups where you can brainstorm and hear other ideas, what other people are doing, you have to temper that with, I think there's some fish stories in there too. People stand up and say they bought a $400,000 house for $10,000. I said, well, maybe. I'm a fisherman myself. But so you temper that, but there's also always real people in those groups who are more down to earth. And,
you got to vet. You got to vet who you're with. No, I think that's important
who you learn from, who you take information from is real important.
Yeah.
and then followed only by who you partner with. I mean, if you get involved in any kind of deal with somebody that turns out to be no good, you've got a major problem.
Yeah.
And we've all seen that many times. We've experienced that, because people do change, and so you'll be very careful about who you get in business with.
No, and I think that's really, really important, especially with there's a new normal that I'm seeing where a lot of people are wanting to just, partner up or squat up or do something like that, where they say it so flippantly, where someone who I don't know comes to me and say, "Hey, will you partner on this deal with me?" I'm like, "Hi, my name's Courtney. Take me on a date first," right? That's a joke there where it's just like, hey, like, it's not something that you want to ever do lightly, but yet I see it a lot of times. People take it that, like, they offer it lightly, they consider it lightly. So
Yeah.
that's important. So one of the questions I love asking anyone as we start to get toward the end of this is, first of all, is what is one lesson that if you learned it sooner, you think maybe things, whether you would have grown faster or achieved financial freedom faster, or whatever that might have looked like. What is a lesson that you wish you would have learned maybe a little bit sooner?
Well, the short-term loans are bad news. I borrowed when I first started. I would buy houses from builders and other people, and I would give them a 5-year note, no payments, no interest for 5 years. Then 5 years would go by, and all of a sudden I'd have this big note due. And 5 years down the road, you don't know what you're going to have going from an economy standpoint. Interest rates could be high, loans could be hard to get. I mean, you may have to sell something for less than what you paid for it 5 years earlier. So short-term loans were one of the mistakes I made early in my career. So my new rule is, if it's not at least 10 years, we're not doing it. I'm only think shorter than 10 years, because 10 years is long enough, I think, for you. At least you see it coming a long way off, and you come up with some kind of strategy to pay that loan off or refinance it.
Yeah.
A lot of times, if you've been making payments to somebody for 6 or 7 years, they don't want their money back. They'd rather have you keep making payments to them, so they become long-term investors, which is a good thing.
Yeah.
So that was probably the one thing that if I could do that all over again, I would have no short-term loans. I'd ask for longer terms, and people say, "Well, nobody will lend you." They will. People, I've had loans, interest-only loans with investors for 25 years now.
Yeah.
They've never received a dime in principal. They don't want the principal. They want the interest only.
Yeah.
So they can go for a very long time.
Well, and I've done numerous private money loans with individuals for 30 years. But in the beginning, I didn't think that was possible, right? That limiting belief. But it wasn't until I started asking them. But it's also getting away from people who are in the business of lending, meaning they want the turn and burn.
Yeah, you don't want to harden the money lender people.
Yeah, the turn and burn. Or, for example, you want to be careful with people who are, maybe they have a home equity line of credit, like they're arbitraging. Like, here's my home equity line of credit, and so that's only good for 10 years. I'm just trying to, today the prime has it at 5, but I want to lend it to you at, 10, right? That's the stuff that I'm capable for, but I want people who they want to return, and they're looking for something more passive. They're not trying to build a business of a turn and burn. And so it also came to, who was I talking to about these types of loans? That helped me achieve the more longer term loans from friends. And so
one of my rules is never borrow money from somebody who has to borrow money to give it to you.
Yeah.
Because you get in that position.
Most hard money lenders are in that position.
They are. That's how they're just making a spread.
They're making a spread.
Yes.
And people love the word arbitrage, but arbitrage has underlying risk.
Absolutely.
And I mean, absolutely. So, okay. So, another question I have for you as we start doing this up was, talk to me about what legacy looks like for you with your family.
Well, the kids know that real estate's a good thing. None of them are probably going to go out and buy a lot of property, but they're buying some. They all have goals to buy some property. Again, if you just buy 2 or 3, that can be enough for a lot of folks.
Sure.
My dad ended up with 3, and those 3 houses provided him more income than his retirement and Social Security put together.
Wow.
So, if it doubles your income to have 3 houses, that's pretty good when you're 80 years old.
Sure.
That's what I encourage people to do, not to overachieve. It's a lot easier to, it's actually harder probably just to buy 3 than it is to go out and buy 5 or 6. Once you get to 3, you want to buy another one, So it's a matter of having some self-control and again, having some goals and just buy what you need.
Yeah.
Because life is too short. I mean, it's fun to be in real estate. We both know that.
Sure.
And we both have bought a lot of property, and I'll probably put together some more deals. I've spent more time trying to help my kids make good real estate decisions and helping them buy things over the last few years than buy it for myself.
Well, and I think that's critical. Your father, so his pension and Social Security combined, those three houses did more.
Yep.
Was he ever full time in real estate, or
No,
no, he was
no,
never.
he worked in the retail business all his life.
Yeah. So again, most the reason I got started in my early 20s was because I did not believe Uncle Sam would be there for me,
A lot of
when
people
I
believe
needed it.
that. Yeah, so
Right? And
that's,
it's even more true now, right?
yeah.
And so, or I mean, the jobs, right? Pensions are not really either what they used to be or even there, various things along those lines. And so it's three houses is not unattainable at all,
No.
but it's powerful over time.
I talked to somebody else the other day who I've known for years. He's a few years younger than I am, but he just retired. He has two houses, and he can live off the income from just those two houses. Well, it doesn't take a lot.
Yeah.
Even one house makes a difference. But if you study a little bit, if you really want to spend some money and have a little more fun in the world, then you need a little bit more money.
Yeah.
Then maybe you go for more. But like I say in the book, one house a year is plenty for anybody, really.
Speaking of spending money and having fun, I know that is a lesson I've learned from you. Thinking of the difference between being a starter, estate builder, and an ender. With the ender part, I really appreciate how you guys have embraced what the financial freedom has done for you guys with the travel. I know, I believe it's your daughter who lives in Australia. Is that right?
She doesn't anymore, but she lived there for 7 years.
Yeah. So she lived over there, but okay, you would travel. You have your your boats, the
4
plane.
times a year to Australia.
Yeah, plenty of times. And so,
Yeah.
what role has that played for y'all? Because some people talk about that, like look at my jet, look at my Lamborghini, things like that. But and that's generally not, first of all, what I'm looking to. I'm looking for people who have time freedom and they can enjoy life. So what has that played for you with the legacy you're leaving your family?
Well, and again, it all kind of ties into what we've talked about today, having fewer properties, having as few properties as you need to make it work for you, So with 3 or 4 houses, you can probably do a lot of traveling and not have to worry about your 3 or 4 houses. If you have 50 or you had a 20-unit apartment building, it's harder to leave it. It's harder to walk away from that. And that's what, we've had a lot of friends who had businesses, but they would never take vacations because if they took a vacation, if they're either doctors or run businesses, they said, it costs me too much to take a vacation. I'm making $10,000 a week. I can't leave it behind. I got to make $10,000 a week. Well, if you have houses that are making you $10,000 a month, then you can leave that behind because they don't take all of your time.
Yeah.
So the big contrast between Jack Miller, my good friend Jack, and myself was Jack, to my knowledge, he never spent a dime. He kept it all, And I love spending money. I have boats, planes, cars. We travel all the time, and I've always done that. Even from the beginning, we've put lifestyle ahead of just trying to make a lot of money because you can do both. You can do both. And you could, I can go skiing for 2 weeks without spending much money by staying in a cheap hotel room with 2 other guys.
Right.
So you can do that. You get to stay
in
in
moderation.
A hotel. Yeah, you get to stay in a hotel room all by yourself if you have more money.
Sure. Well, sure, all by yourself. But I mean, I think that's important because I think some people don't know how to balance it, right?
Yeah.
So it doesn't have to be to one extreme where you're never spending the money. It doesn't have to be extreme where you're overspending and going into major debt.
That's right.
There's a level of that. And so I really appreciated that about you because it's a level of, sometimes in our circles, it could be, you build the wealth and you make the money, but then you also have to penny pinch and not, spend it.
Well, you want to be, you're trying to be smart about money. And that doesn't mean you never spend any, but, you don't just blow it. It's not like you won the lottery and you go out and you don't have any money left in 2 years, which happens a lot because you're not smart about money. So if you learn and you get smart about how you make money and then how to keep it, you'll have lots of money.
Yes.
But most people don't learn. 90% of the people don't accumulate much money. They totally relying on Social Security or their pension or something to make their payments when they retire. And so they don't have much money.
Right.
They have some, but not much.
Right. And so talk to me about the legacy you want to leave on the real estate industry. So other investors, obviously your book, again, it's the #1 book that I recommend people to read for real estate investing. You're now to where you're teaching, 1 class a year.
Yeah, 1 or 2 of the
1 or 2, something like that, where it's not much.
And I haven't taught more than 3 a year since 1982. When we first started having our family, I cut way back on teaching because that's my main source of income is not teaching. It's investments.
Sure.
Yeah.
But what do you want, when you think of, the impact you want to have on the industry, what does that look like for you? What does that mean
Well,
for you?
I'd like to see people get more involved in their local government so they don't, so we can slow down the government interference on private property rights.
Yeah.
The government really, when they come up with some law where they want to inspect other property, all their property, they're really not trying to help anybody. They're just trying to raise money. So you can stop that because
Yeah.
there's nobody on the other side of that except the government. There's city of New York just announced they're going to start charging people $15 a day to drive downtown. That's not going to do anything but raise a whole bunch of money for the city of New York. It's a fundraising thing. So
Sure.
you have to see that kind of thing coming and organize and resist it. But the other side is doing things right. Doing things where you're helping people when you buy property, where you have good relationships with your tenants. Because by doing that, by being a good landlord, then you're providing quality, affordable housing in your town, and that's a big demand.
Sure.
Big demand.
Yeah. So I definitely appreciate the way you guys have shared. Again, more than anything, sure, the deal making is helpful, but the philosophies is what's really shaped me from you guys, right? Like that is what I'm most grateful for, because one of the things I say, it's how you do real estate matters. So it's not just the technical, it's like maybe how you structure the deal, the financing, all that, but it's also how you treat people, how you treat your tenants.
Absolutely.
And all that. And I'm really thankful for that, because one, it's absolutely a message I want to continue to see carried on, but it's changed the way I do real estate, and it resonated with me. Like this again, when I first met Leon, who was one of your students, I mean, I stood up like, that's what I want, and so I really appreciate that. Thank you for all that you've done. So tell us more where people can. Let's highlight the book one more time. So Building Wealth One House at a Time. This is the third edition. So people
third edition. Buy this on Amazon. We don't sell them from the office, but you get it on Amazon. Building Wealth One House at a Time. I have recorded 12 different courses. They're all about 4 or 5 hours each, and they're all available on my website. You can just download them. So you're going to give them information on how to get to it. But my website is johnschaub.com. Pretty easy, just my name.
I'll include that in the show notes as well as on the video. But yeah, so I actually have the majority of those like they're like weekend classes, right? And I think this weekend I literally have a picture of all the ones I have, and I'm like going to get the rest of them because I have those are in my office. I've referenced them, and so your website, we'll make sure they have that. John, thank you so much for.
Well, you keep up the good work, because at some point I won't be doing this, so I depend on you and Leon and the younger generation. Leon will like that.
He'll like that.
The younger generation spreading the word, because there is a right way to do it, and you make probably more money doing it the right way than trying to take advantage of somebody. So just be kind to people.
Yeah. Well, look, I thank you for that. And that is part of the goal is you guys have influenced me so much, and I do want to see that torch carry on and that message go forward. That's part of the reason we're doing this, is because I want, most people aren't going to be able to find you on, Instagram or things like that, where
They
you've
won't
got this
find me on Instagram.
yeah, or stuff like that, right? But you guys have such a strong message I want to carry on, and part of the reason I started the podcast was I wanted to interview folks who maybe are not out there being a talking head, and have a huge online presence. And so, thank you so much for the hospitality, having me here today, sharing with me. I'm looking forward to this weekend seminar. And so guys, you can go see his website for anytime you have a seminar, you share it there on your website. And obviously those little weekend seminars that people can buy and download from your site are great as well. Now those are specific topics though.
Very, very specific, yeah. So I mean, like lease options, management,
foreclosures. Yeah, like it's a lot of different ones.
It's like different chapters in the book, but there's just more detail, because it's a whole seminar.
Yeah.
And if I sign somebody's book, I always write the same thing. I always say, build wealth, enjoy it, and share it. Those three things. It's just that simple. Simple formula.
Well, John, that's great. So build wealth,
enjoy it,
and share it.
Yeah.
All right, guys.
Share your knowledge, and it's good to make gifts to people too. So
absolutely.
Sure. Yeah.
Well, this has been a gift to us, so thank you. And so, guys, I hope you guys enjoy it. Thank you.
My pleasure.